More than 60% of people who leave California believe they've escaped its taxes, and that belief is costing families their life savings. Every year, thousands move out, buy new homes, and start over, only to receive a California tax bill demanding tens or even hundreds of thousands of dollars. No warning, no second chance, just a letter that can wipe out years of hard work. The most shocking part, many of these people did everything they thought was right and still lost. Here's the truth most people don't want to hear. Leaving California does not mean California lets go of you. A single mistake, one wrong tie, or even poor timing before March 2026 can legally pull you back into California's tax system, even if you live in another state. This isn't fear-mongering. It's how the law actually works and why so many people get trapped. If protecting your money, your future, and your family matters, subscribe now. This channel exposes the rules others find out only after it's too late. And what you're about to hear could save you from financial disaster. Number 1, California's definition of residency is not what you think. Most people believe residency is simple. You live somewhere, so you pay taxes there. But in California, residency is not based on where you sleep at night. It's based on where your life appears to belong. California law looks at your intent, your habits, and your connections, not just your address. This is the first and most dangerous misunderstanding that bankrupts people after they leave the state. Under California rules, you can move out, rent an apartment in another state, and even change your mailing address, yet still be classified as a California resident for tax purposes. Why? Because the state examines your entire lifestyle. Where do you keep your valuables? Where is your primary home? Where do you return after travel? Almaseki? Even small details can paint a picture that says, this person never really left. What makes this especially brutal is that California does not need your permission to decide your residency. Once the state believes you intended to return, the burden shifts to you to prove otherwise. That means documents, timelines, explanations, and stress, all while interest and penalties quietly grow in the background. Many people lose simply because they cannot prove intent clearly enough, even when they truly moved. If you are planning to leave before March 2026, this rule alone can cost you an entire year of California taxes. And most people don't realize the danger until it's too late, when the letter arrives and the clock starts ticking. If you want clear, honest breakdowns that protect your money and your future, subscribe now. We don't chase headlines. We expose the rules that quietly destroy people who weren't warned. Number 2, a temporary move can keep you trapped as a California tax resident. One of the most expensive mistakes people make is assuming that time away equals freedom from California taxes. In reality, California makes a sharp distinction between a permanent departure and a temporary absence. And that single word, temporary, is where countless people lose control of their finances. You might believe you've left for good, but if California believes your move was temporary, you never truly left in their eyes. Here's what makes this dangerous. California does not define temporary by how long you are gone. You can live outside the state for months, even years, and still be labeled a resident if the state believes you intended to return someday. Job assignments, caring for family, short-term contracts, or even trying out another state can all signal that your absence was never permanent. The state looks at your mindset at the time you left, not the story you tell later. This is where people panic. They moved, paid rent elsewhere, maybe even paid taxes in a new state. Yet California still demands its share. Why? Because intent is judged by evidence, not emotions. Keeping a home available, maintaining California doctors, storing personal belongings, or returning frequently can quietly build a case against you. Even innocent actions can be interpreted as proof that California was always your real home. The harsh reality is this: you must prove permanence, or California assumes temporary. And once the state makes that assumption, the burden falls on you to undo it, a process that is stressful, expensive, and uncertain. Many people don't lose because they were wrong, but because they weren't prepared. If you're planning to leave before March 2026, understanding this rule could save you from years of unexpected tax liability and financial regret. If you care about protecting what you've earned, subscribe now. This channel exists to warn you before the damage is done, not after the bill arrives. Number 3, owning or keeping property in California can destroy your exit plan. Many people believe they can move out of California while keeping their house just in case. That single decision has financially ruined more exit plans than almost anything else. To California, property is not just real estate, it's evidence. And owning or controlling a home in the state is one of the strongest signals that you never truly left. Here's the harsh reality. If a home is available for your use, California often treats it as your real base of life, even if you claim to live elsewhere. It doesn't matter if you rarely visit or if you emotionally consider yourself gone. What matters is whether the home could be used by you at any time. An empty house, a lightly rented property, own or a family-occupied home can all raise serious red flags during a residency review. What shocks most people is how easily this backfires. Someone moves to another state, rents an apartment, and assumes they're safe, while their California property silently works against them. During an audit, the question becomes simple and brutal. If things went wrong, where would you return? If the answer points to California property, the state sees intent to return, and residency follows. Even selling the home too late can hurt you. If major income, bonuses, or asset sales happen while you still own California property, the state may claim taxing rights over everything, even after you physically moved. This is why timing matters as much as the move itself. One delayed sale can turn a clean exit into a financial nightmare. The most dangerous part? People keep property for emotional security, not realizing it creates legal vulnerability. California does not care why you kept the house, only what it proves. If you're planning to leave before March 2026, understanding how property ties are evaluated could mean the difference between freedom and a devastating tax bill. If protecting your future matters, subscribe now. We break down the traps others discover only after their savings are on the line. Number 4, your bank accounts and spending patterns can expose you. Most people never imagined that everyday spending could determine where they owe taxes. But in California, your money leaves a trail, and that trail can quietly prove where your life truly exists. Bank accounts, credit cards, and transaction histories often become some of the most damaging evidence in a residency review, because numbers don't argue and patterns don't lie. California looks closely at where you spend, not just where you say you live. If your cards are regularly used in California, groceries, fuel, restaurants, medical visits, subscriptions, it creates a clear picture of daily life. Even if you have a new address in another state, consistent California spending suggests your routine never really changed. To auditors, that means your center of life may still be in California. What makes this especially dangerous is how unintentional it can be. Automatic payments, old subscriptions, familiar service providers, all of these continue quietly in the background. You may not notice them, but California does. Over time, these transactions form a detailed behavioral map that's far more persuasive than a moving receipt or lease agreement. Many people are shocked to learn that their own financial history worked against them. Another common mistake is maintaining long-standing California bank accounts while opening new ones elsewhere. To the state, this can signal hesitation, uncertainty, or ongoing ties. When combined with California-based spending, it strengthens the argument that your move was never fully committed. And once that assumption forms, the burden again falls on you to prove otherwise. The brutal truth is this: how you spend after leaving matters just as much as how you move. If your financial behavior still points back to California, the state may legally pull you back into its tax system, even if you believe you've cut ties. If you're planning to leave before March 2026, reviewing and restructuring your financial footprint is not optional. It's essential protection. If you want guidance that shields your money and your peace of mind, subscribe now. We uncover the invisible risks that cost people everything when no one warns them. Number 5, your driver's license, vehicle, and insurance can betray you. Many people leave California believing paperwork can wait. They move first and plan to update documents later. But in California's eyes, what you drive and how it's registered speaks louder than where you sleep. A California driver's license, vehicle registration, or insurance policy can quietly undo your entire exit, even months after you think you're safe. Here's why this is so dangerous. A driver's license is one of the strongest legal declarations of residency. If you keep a California license after moving, the state sees it as a voluntary statement that you still belong there. The same applies to vehicle registration. A car registered in California suggests daily use and continued presence, especially when paired with toll records, parking data, or service history. Insurance adds another layer. Auto and homeowner policies list primary garaging locations and risk zones. If those locations remain in California, it directly contradicts claims of living elsewhere. During an audit, Insurers' records often align perfectly with transaction data and travel patterns, creating a timeline that's difficult to dispute. Many people never realize their own insurance documents became evidence against them. What makes this trap brutal is how common it is. People delay changes to avoid hassle, fees, or long DMV lines, but California interprets delay as doubt. The longer documents remain unchanged, the stronger the case that your move lacked permanence. And once the state believes that, reversing the assumption becomes extremely difficult. Even worse, fixing these issues after an audit starts rarely helps. California evaluates what existed during the tax year, not what you rush to change later. That means one overlooked detail can cost you an entire year of taxes, penalties, and interest. If you plan to leave before March 2026, your document timeline must match your story exactly. Anything else invites scrutiny, inquiry, and expensive consequences. If you want clear guidance that protects your future, subscribe now. We help you avoid the silent mistakes that turn a clean exit into a financial disaster. Number 6, your job, clients, or business income may still be California sourced. One of the biggest shocks for people leaving California is discovering that moving your body does not always move your income. Many assume that once they cross state lines, their earnings are automatically free from California taxes. That assumption is dangerously wrong. California looks at where income is generated, not just where you sit when the money arrives. If your employer is based in California, if your clients are in California, or if your business operations still rely on California infrastructure, the state may classify your income as California sourced. Remote work does not magically sever tax ties. In fact, remote workers, freelancers, consultants, and online business owners are among the most audited groups, because their income trails are complex and easy to misinterpret. Here's how people get trapped. Someone moves to another state but keeps the same role, the same clients, and the same revenue streams. Payments continue uninterrupted and life feels normal. But during a review, California asks simple questions. Where are the clients? Where are decisions made? Where is value actually created? If too many answers point back to California, the state may claim taxing rights over that income, even after you moved. Business owners face even greater risk. LLCs, corporations, partnerships, and sole proprietorships with California registrations, employees, or operations can anchor you to the state long after you think you're gone. Even digital businesses are not immune. Servers, contractors, management decisions, and customer bases all matter. What feels like freedom can quietly become continued exposure. The most brutal part is timing. Income earned during the transition period, especially around bonuses, commissions, stock options, or large contracts, is heavily scrutinized. One poorly timed payout can pull an entire year of income back under California's tax authority. If you're planning to leave before March 2026, restructuring how and where your income is sourced is not optional. It's survival. Ignoring this step is how people lose more than they ever expected. If you want to protect what you earn and what you've built, subscribe now. This channel exists to expose the income traps that quietly bankrupt people who thought they were already free. Number 7, your social, medical, and family ties can trigger a residency audit. Most people think taxes are about money. In California, they're also about your life. Your family relationships, medical care, and social connections can quietly determine whether the state believes you truly left or merely took a break. This is one of the most overlooked and emotionally charged reasons people get pulled back into California's tax system. California evaluates what it calls your center of life. That includes where your spouse lives, where your children attend school, where you see doctors, dentists, or specialists, and where you participate in religious, social, or professional communities. If these ties remain anchored in California, the state may argue that your real life never moved, no matter what your address says. Yes, this is where people feel blindsided. Someone relocates for work but leaves family behind temporarily. Another keeps long-standing doctors due to trust or medical history. Others continue attending the same church or professional organizations out of loyalty and comfort. These choices feel personal, not financial, yet to California, they are powerful evidence of intent. Emotional attachment becomes legal exposure. Medical care is especially influential. Consistent appointments with California providers signal stability and permanence. When combined with family ties or frequent visits, it strengthens the claim that California remains your home base. During audits, these details often appear alongside travel records and financial data, forming a narrative that's difficult to break. Yeah, what makes this rule brutal is that it punishes normal human behavior. People don't want to uproot families overnight or abandon trusted doctors. But California doesn't evaluate fairness, it evaluates facts. And the longer these ties remain, the harder it becomes to prove you genuinely established life elsewhere. If you're planning to leave before March 2026, you must understand how your personal decisions can unintentionally create tax risk. Ignoring this factor has cost people not only money, but peace of mind and years of stress. If this kind of truth matters to you, subscribe now. We expose the hidden rules that affect real lives. Know before they turn personal choices into financial punishment. Number 8, leaving at the wrong time can cost you an entire year of taxes. Timing is a silent killer in California tax residency, and it's where even well-planned exits collapse. Many people do everything right on paper, yet lose tens of thousands of dollars simply because they left at the wrong moment. In California, when you leave can matter more than how you leave. California closely examines exit timing, especially around the start and end of a tax year. If you move after earning significant income, receiving a bonus, selling assets, exercising stock options, or closing a business deal, the state may argue that the value was created while you were still a resident. One poorly timed event can pull all income for that year back under California's tax authority, even if you moved shortly afterward. Daupati, what shocks people most is how narrow the margin can be. Leaving in late spring instead of early winter, finalizing a move days after a payout instead of before, delaying a lease or home purchase by weeks. These small decisions can change your tax outcome dramatically. California doesn't see them as accidents. It sees them as evidence of planning around taxes, which invites scrutiny. The danger intensifies before March 2026. Large income events clustered near your departure date raise red flags and often trigger deeper reviews. During audits, California reconstructs a timeline, where you were, what you earned, and when your intent to leave became clear. If that clarity comes too late, the state may claim residency for the entire year. This is why last-minute moves are especially risky. People rush, underestimate documentation, and misjudge how timing affects perception. The result is devastating. A clean exit turns into a financial setback that could have been avoided with proper planning. If you're planning to leave California, timing is not a detail. It's a decision. Get it wrong, and the cost can follow you for years. If you want protection, not regret, subscribe now. We help you avoid the timing traps that silently drain savings when no one explains the rules clearly. Number 9, California uses aggressive, data-driven audits to pull you back in. Many people still believe tax audits are rare, random, or based on obvious mistakes. That belief is outdated, especially in California. Today, residency enforcement is data-driven, strategic, and relentless. California doesn't need a dramatic reason to question your exit. It only needs patterns that don't fully add up. The state cross-checks information from multiple sources to build a complete picture of your life. Travel records, property data, vehicle registrations, financial activity, employment details, and even third-party reports are analyzed together. Each item alone may seem harmless, but combined, they can suggest that your ties to California never truly ended. Once that picture forms, an audit often follows. What makes this especially brutal is that audits rarely begin with accusations. They start quietly. Start kedua, a letter, a request for clarification, a demand for documents. Many people underestimate these early stages, respond casually, or provide incomplete information. That's when the trap tightens. Every response becomes part of the record, and inconsistencies are used to justify deeper scrutiny. California's approach places the burden of proof squarely on you. The state does not have to prove you were a resident, you must prove you were not. That means assembling timelines, receipts, travel logs, contracts, and personal explanations that align perfectly. Missing or weak documentation can be interpreted as evidence against you, even if your intentions were honest. Once an audit escalates, the cost rises fast. Professional representation, although time lost, stress, and potential penalties compound quickly. Many people settle not because they were wrong, but because fighting becomes financially exhausting. By the time they realize the seriousness, the leverage has already shifted. The hard truth is this: California assumes nothing and trusts no one. If your exit leaves behind unanswered questions, the system is designed to pull you back in. If you want clarity instead of panic, subscribe now. We explain how these audits work before they start, not after your savings are already at risk. Number 10, Once California labels you a resident, escaping is painfully expensive. This is the final and most devastating reality most people never prepare for. Once California decides you are still a resident, the fight is no longer about logic, it's about endurance. At that point, the state already believes it is right, and undoing that decision becomes a long, expensive, and emotionally draining process. Challenging California's residency determination is not simple paperwork. It often requires years of documentation, professional representation, and constant back and forth communication. Tax attorneys, accountants, and legal advisors become necessary, not optional. And the costs add up fast, not just in money, but in time, stress, and lost focus on your life and career. Even people who ultimately win often spend tens of thousands of dollars just to prove they were telling the truth. What makes this especially brutal is that penalties and interest don't pause while you fight. California continues calculating what it believes you owe, quietly increasing the pressure. Many people reach a breaking point and settle, not because they were wrong, but because continuing the fight becomes financially unbearable. The lesson is harsh. Being right doesn't always mean you can afford to prove it. The system is designed this way. California knows most individuals don't have unlimited resources. Once you're labeled a resident, the leverage shifts completely. That's why prevention matters more than defense. Every step you fail to plan before leaving becomes a weapon used against you later. If you're considering leaving California before March 2026, understand this clearly. The cheapest, safest option is never giving the state a reason to question your exit in the first place. Waiting until after a problem appears is how people lose control of their finances. If you want to stay ahead of these traps and protect everything you've built, subscribe now. This channel exists to help you avoid the fights that ruin lives, not teach you how to survive them after the damage is done. Leaving California before March 2026 is not just about packing boxes or changing an address. It's about understanding how aggressively the state defines tax residency and how easily people fall into traps they never saw coming. As you've seen through these 10 reasons, California doesn't look at one action in isolation. It looks at your entire lifestyle, your timing, your financial behavior, your personal ties, and even your intentions. Miss just one detail and the consequences can follow you for years. What makes this situation especially dangerous is that most people who get caught never believed they were doing anything wrong. They moved, started fresh, and assumed the system would recognize that change. But California doesn't operate on assumptions. It operates on evidence and patterns. And once the state believes you remained a resident, the burden shifts to you to prove otherwise, often at a massive financial and emotional cost. The real takeaway is this: tax freedom requires planning, not hope. Leaving at the wrong time, keeping the wrong ties, or delaying critical changes can turn a smart move into a devastating mistake. That's why awareness matters. Knowing these rules before you act gives you leverage, clarity, and control, not panic after a letter arrives. If this video opened your eyes, you're not alone. Thousands of people are facing these issues right now, wishing they had understood the risks earlier. Don't let that be you. Stay informed, stay intentional, and never assume California will let go just because you left physically. If this content helped you think differently, support this channel by subscribing. We break down complex laws in plain language so you can protect your money, your future, and your peace of mind before it's too late.